Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmian, and with me in the studio is my friend and colleague Niklas Sävås. How are you?
I'm all good. Yesterday we finished the annual Serial Acquirers Conference, which was fantastic, so I feel great today.
Today we are excited to have David Marcus on the show. David is a US investor with strong connections to Europe and Sweden. And David is also an entertaining person, full of fascinating insights and stories from his decades in the financial market. So this will be fun. Which book will we speak about?
So David has selected How to Make a Few $1 Billion, written by Brad Jacobs. And Jacobs is a serial entrepreneur who has built a number of billion-dollar companies through an acquisition-driven approach.
How to Make a Few $1 Billion was published in 2024, and we are thrilled to speak about the book today. Here comes our conversation with David Marcus. Hi, David, and welcome to Investing by the Books podcast.
It's great to be here.
It's our pleasure and wonderful to have you on. Last time we met was in New York, 2022. We had dinner there. This week we had the pleasure to have you at the conference, the Serial Acquirers Conference here in Stockholm. How do you feel now?
I feel good. I really liked the conference. It was the first time I went. I really liked it. I met a lot of companies and a lot of the people that attended. And so I learned a lot and I got to see a lot. And I have a lot to think about now as a result.
And for those not familiar with you, how was your background? How did you get into investing in the first place?
Well, we have to go back in time quite a ways. I guess I'll give the quick version, but I was very lucky. I grew up in a house in New York, in Long Island, where my father and my uncle owned a two-man stock brokerage firm. And they talked about stocks all the time. And so I was always around the discussions of investing and finding interesting companies. In those days, they were always talking about finding the next IBM or the next Xerox. Those were the big ones of those days. And even when I was a kid, I would ask them, why aren't you buying IBM or Xerox? Why do you need the next one? So there was always a debate and a discussion about companies. And then one day my uncle took me to the New York Stock Exchange, where you could go to a visitor's gallery and oversee the exchange. And at that point, it was, I would say, to me, it looked like it was the center of the financial universe. It was just incredible. So I was hooked from that minute. I knew I really wanted to be somehow connected to investing.
And how old were you then?
I was probably 14. So then I started subscribing to magazines like Fortune magazine and Forbes. Yes, other kids were interested in different kinds of magazines, and not me. And so I did that, and I would read anything I could find on the stock market, how it worked, who the players were. But I was always fascinated by the history of it. So I would find old books about the people from 80 years ago, 100 years ago, and how they did it. I just wanted to learn and read a lot.
And were you allowed to invest anything?
Yeah. And so I would track, like I said, I would speak to my own father and my uncle about it. And I just wanted to read about the companies, and we would pick companies. And I realized even then I liked conglomerates and holding companies. And I remember one of the first stocks that I picked myself was a company called Gulf and Western. And Gulf and Western was a crazy conglomerate. It doesn't exist anymore. But their biggest asset was Paramount Pictures, the movie studio, which has subsequently been sold quite a few times. And then there were corporate raiders. So there were these guys that would attack these conglomerates and push them to break up and sell off all the pieces. And so I would just track them and watch those guys. And I realized there's so much value in these conglomerates because the investors don't know how to look at them or how to value them. So over time, I just really started thinking about big companies that just had a lot of different kinds of businesses, old industrial businesses. And because even then, so at that point, I wasn't 14 anymore, I was older, but I realized that investors were shifting more towards companies that did specific sectors or industries. And kind of they forgot about these other ones. But they were very asset rich. So these corporate raiders would come in and try to take control and push them to break up. So for university, I went to a school in Boston called Northeastern University. It really was a great place to go because it helped me. It was a 5-year so in the U.S., most schools are 4 years for a university. This is a 5-year school because but it's still 4 years of education because you go there and during the 5 years, you have to get a job. You have to interview, you learn how to interview, you compete against other students, very competitive. And you work 6 months full-time 3 times over the course of the 5 years. And so when you graduate, you have actual real experience working. And I was very lucky that I worked at a bank in Boston that did the back office for he wasn't well known at the time, but who became an extremely well-known Wall Street guy who really was my first real boss on Wall Street. And that was Michael Price, who I worked for many years. And so the bank recommended me to him. And in 1987, I worked right around the corner from the New York Stock Exchange. But in that year, there was a stock market crash. So in the U.S., there was a massive crash. I think in one day, I think the stock exchange was down 22% in one day. My job was answering the phone. Investors would call. It was a mutual fund company. I think at the time it had maybe just under $2 billion. It was one of the largest mutual funds in the United States. And Michael was sort of just coming up as a well-known investor, as a value investor, but also a creative investor. He wasn't just picking stocks that he liked, but he liked the deals when there were a lot of mergers in those days, and they would play these arbitrage spreads between the announced deal price and where the stocks were trading. And so most investors, after a deal was announced, the stock would go up, but not to the full price because it would take time for the deal to close. And he would buy it then sometimes and then just play that spread, and on an annualized basis. Sometimes it was a very high rate of return. And so that became a whole industry that a lot of people started to do. But he was so early in that kind of investing. And so when the crash happened, it kind of was a big disruption. But I got to watch him and the rest of the team and how they operated during a crisis. They didn't panic. They didn't go crazy. They just sat back, watched the carnage, and thought, how can we take advantage of this? And so it was one of the earliest lessons for me, which was crisis can create opportunity if you don't panic. It doesn't mean you have to start buying things the first minute of the crisis, but it's a period of time where when everybody's panicking, if you are rational, you can see that people, in the panic, people start throwing everything away. They want to get out of everything. They're selling the good ones, the bad ones. It doesn't matter. They just want to get out. And their view is, we'll worry about getting back in at some point if we ever get back in. So you just realize, so that was such a valuable lesson where I was just in my early 20s at that point. So it was a good kickoff. And then I just wanted to work in the business. So by the time, so the person who had started the company was an older guy who had come to the U.S. from Germany in the 1930s, Max Heine, and Michael worked for him and trained under him. And that guy had really developed a skill that he would look at bonds that were defaulted, but they had a lot of assets. And so that he helped train Michael to look at all the footnotes and all the bond indentures, because most people didn't look at these things. And they realized these were very asset-rich companies, even though they had no cash flow. So they were in bankruptcy. But when they started selling assets, people could get enormous returns. So you were buying bonds at 10 or 20 cents on the dollar. And at the end, they paid more than 100 cents on the dollar because they paid the full amount, and then they paid the interest that had accrued for many years. And so there were a lot of these interesting companies going through big bankruptcies really in the U.S. Most of the railroads went out of business. The government took them over. And so again, so he learned crisis creates opportunity. He trained us to learn that as well. And so it was just, you're forever learning. I think that's the reality of it.
And you weren't sort of scared off of the crisis that came so early and sort of the situation you were in. Was that because sort of Michael and the other, people in the team, that they didn't sort of freak out in that episode, you think? Or
I think it was helpful for sure to see everybody outside was freaking out. We were already getting lots of phone calls from investors, but one day it was investors who wanted to invest in the fund. The next week, it was investors who wanted to get out of the fund because they were panicking. Well, the way the system worked in those days, you could add to your investment on the phone. You couldn't take your money out on the phone. You had to send in a letter. You had to get it stamped at a bank to confirm your signature. And people didn't realize that till the crisis. And so it was more panic. What do you mean I can't sell it today? And so it was, eventually that changed, especially with technology and internet, and you could do everything online, but that came years later. But yes, they were calm during the storm, even though his fund was down a lot. He just focused on how can I take advantage. And so it's great to get those lessons early in your career. If everything just works for you right away, then when something bad happens, you have no experience in it. I think it's better to see the problems because it really helps you understand what can go wrong. You learn it. You learn a lot. You learn more. Sometimes you learn more from the crisis, the mistakes, the problems, than you do from the successes because it helps you avoid. It's like getting the map to the minefield, right? You know what to avoid. You know where the issues are.
And we will speak more about your career and what has happened since then. But for this episode, we will speak about a book. And you mentioned successes, and I think this is a pretty successful story. How to Make a Few $1 billion is the title. Pretty humble title.
Sure is.
How did you first come across the book?
Well, I had heard about Brad Jacobs, who wrote the book. It's his autobiography, because he was such a prolific business builder. He was a serial entrepreneur. And so he would make many acquisitions, but he would stick to one sector in a company, make a lot of acquisitions, it would be a listed company, and then he would build another one in maybe a peripheral or nearby sector, but not necessarily the same industry. And it wasn't just creating sort of a serial acquirer across industries. It was a serial acquirer in a specific industry. But then he'd build another company and another one and another one. And I think the largest one is United Rentals. That's a global business. I think it's a $50 billion company today, market cap. And he built it from nothing and made hundreds of acquisitions. So in any case, I had already known who he was, and I just happened to be at an event where he was the keynote. And I heard him speaking. I thought he was, like the title of the book, a bit humble. Now, he has a lot to be proud of what he's achieved. And so he talked about the businesses he built, but he started talking about the business he wanted to build. In other words, his next one.
When was the conference?
That was just over 1 year ago. And so and at the time the book had just come out and they were giving it out at the conference. Well, I'm a value investor. Free book is never a bad thing. And it was autographed. And so, but I listened to him and he was talking about this idea to build a company that would focus on the building products industry. So he would look for fragmented industries where there's a lot of small players, raise capital, and then make a good-sized acquisition, but then layer on other ones on top of the foundation of the big acquisition. But the way he spoke about how he built businesses, I thought, this is fantastic. And I guess we'll get into that in a minute. But the reality is, I said, okay, I don't want to just get a free book. I actually want to read it and understand it, because here's somebody who has built more than 5 companies that are multi-billion-dollar businesses. He's in his, I think he's 67 or 68 years old. He's not an old guy. And he had already achieved so much. And yet, what did he want to do? Another one. And so, and I think out of the 5 companies he started from scratch, 2 of them had spinoffs that became multi-billion-dollar. So effectively, he built 7, I think it was 7 multi-billion-dollar companies. Really, absolutely remarkable. And so, I started focusing on trying to consume as much information on him and understand it. But frankly, then pretty quickly, I reached out to his group and just said, hey, I saw Brad present, and I am really interested to know more about what you're talking about, because they were going to be raising money for the next idea. So this book, and in the book, going back to the book, he highlights his start as just a kid who had a few $1,000s, and I remember he said he saw something on some television show about oil traders in Europe, how they were becoming these incredibly wealthy guys because they were trading oil during all these oil crisis periods that were happening in the 1970s. And he said, I should become an oil trader. He was like 22 or 23 years old. He said he didn't know anything about it, and he talks about that in the book. And he took the few dollars he had, few $1,000s, and somehow he set up some oil trading business that eventually became a large business. So even early on, he was just wired to succeed. He just had the drive, the passion, and if he didn't know it, he learned it. He wasn't waiting for somebody to teach him how to do something. He decided he would do it himself. But in the book, he talks about how early on he was focused on business, but he was also into music. And he debated to be a musician and not go for the gold, or the business guy. And eventually he chose to go to be the more of the capitalist. But maybe he came out of the success he had, and it just pulled him into that area. But over the years now, you see how much he has built. And when you meet him, talk to him, see him, he's done quite a few interviews, you just see the passion, the drive. You see it with some of the serial acquirers that I saw at your conference and that we know exist. And when you see that, you kind of want to be part of it, as long as you think you could also, I'll say, ride along with them. Not every business builder is taking the shareholders with them. Some of them do other things to the shareholders that are not good. But no, in his businesses, and I mean, in the book, he highlights sort of these points, which is finding sectors that are, so he started with the oil business, but then he moved on to other businesses. And then eventually he got into this role of rolling up certain industries, but he would target businesses and sectors where there were a lot of players. They were very fragmented industries, and there was no real main leadership. Maybe there were a lot of, as we would call it, mom and pops, yeah. Right? They were family-owned smaller businesses, or if they were more groups that didn't have a main owner, they still were just maybe more modest size, and they'd go in, get one, it creates the base, and then add the others on it. So as opposed to some of the serial acquirers that want to keep a lot of these acquisitions sort of unique and let them run and manage the way they are, the model he had was, on top of the foundation, the new one should be let's adopt a lot of technology. Let's modernize it. Let's take advantage of the trends in technology. It's one of his key points. And understand the people, and he was very people-focused, technology-focused, opportunity-focused, but layer on the new business, the new acquisitions on top of the platform that they were building, so that it was a unified strategy instead of 50 or 80 or 90 different acquisitions. So it's just a different model. I wouldn't say it's better or worse than any other model, but for what he was building, to build specific companies for specific industries, it was an excellent model. So United Rentals, they rolled up the rental of equipment market, heavy equipment, lighter equipment for backhoes and diggers and whatever, all kinds of equipment. And because every town had a rental company, or actually in a lot of cases, the larger construction companies would buy the equipment for big projects, and then they'd have all the equipment left over till they had another project. And so they realized there was a huge opportunity in building rental businesses. So they were smaller businesses, and then they turned it into an actual, real, vibrant, growing, productive business. That's why it's been so successful globally. It's not just a U.S. business. It's around the world.
I mean, David, as you said, I mean, Jacobs has a different way of running things than the typical sort of Swedish serial acquirer. I mean, he emphasizes integration, synergies, centralizing certain function, doing some larger deals, as you mentioned, to build that platform. Do you think sort of the Swedes can learn from the model that the Jacobs had? Do you think they could sort of add their model in any way using his framework?
Well, it depends on what their business is, because we have seen here so many interesting companies that they buy the business, they love the people who built them and the quality of the business, and they have no interest in changing it.
Yeah.
They want to keep it unique. Look, frankly, Warren Buffett does that, right? So he has kind of two buckets, right, where he buys a whole business, and then he has where he has investments in the stock market, where that's maybe a buy and one day a sell, where the acquired companies, he's going to keep them forever. He says he's not going to sell them. And so same here in Sweden with groups that are doing similar, where they buy the whole thing. They're not looking for turnarounds. They're not looking for things that can be fixed. They're not private equity guys thinking, let's buy it, and the first thing we do is get rid of management, and we know better than them. Well, aren't you attracted to it because you like what they do? So why do you want to start making how do you know better than the guys doing it? Unless it's a company where it's been undermanaged and it is fixable and you can create more value out of it. That's not the business that many of the serial acquirers in Sweden are doing. They're buying good businesses. I mean, whether it's Lifco, Röko, we could go through the list. They're not looking for trouble. They're looking for great, or very good at least, that can operate on their own. But yet the founders of those are willing to sell, whether they're retiring or whatever the reason is. And so both models can work.
Yeah.
And so for certain kinds, yes, I think the way Brad Jacobs does it, it does work. He's proved it works.
Yeah.
So it's not just a U.S. thing. It can work anywhere. But some of the serial acquirers, I think they will roll up in some of the verticals they're in. So they're buying different businesses, but then they could have add-ons. And those add-ons sometimes are smaller. They'll go into an existing business. But they're not really platform companies where they're saying we need 10 more like this. Because most of the serial acquirers are ridiculously opportunistic. And just to, I think one more thing on or however many more things you want to talk about Brad Jacobs, but he sets very high goals and targets. Why? I think you could simply say you aim high so that you could land high. If you aim low, it's hard to land high, right? So they set these crazy targets, and then they have to do everything possible to get to those targets. But then he rewards his people. They get equity. They get all kinds of incentives, and so he seems to be I'll say a tough leader of the businesses, but he wants to bring everybody with him, meaning if you're a real contributor in his companies, you get very well rewarded.
Yeah.
And so you see people that are in his group tend to be there. I'm sure it's very tough, and I'm sure it's not easy to be there through, especially downturns in those industries and so forth, because you have to deliver. So, but they become very seasoned, and the more seasoned the people are, it turns out you want the skill sets, and some of those people can help in the next industry or in the next business that's created. And so you see some of the people end up in multiple businesses there. You could track how they move around to the boards or to the businesses. But setting these huge targets and these huge goals, I would say some of the ones here, they're it's just a different level of opportunistic investing, because they're not really setting a goal for that. I'm sure each of the businesses are setting goals that the serial acquirers buys, but because Jacobs is doing this roll-up strategy that's really in one industry, it is setting different goals for things. But again, all companies have goals.
Yeah.
Right? Some just talk about them, some deliver on them.
Yeah.
I like the ones who deliver.
And I mean,
but I hope that the ones that don't deliver, if I have competitors in the investing world, I hope they buy those.
Yeah.
And
I mean, in my view, the model that Jacobs has resembles sort of the private equity roll-up model, but with the key difference being that they have a perpetual holding period, and private equity has a quite short holding period. What I have seen and heard is that sort of private equity is moving out from the maybe shorter holding period in some aspects and trying to hold on to the assets for longer. Well, what's your view on that? And do you agree on this resembling sort of private equity roll-ups?
Well, I think private equity is evolving. I think you're absolutely right. Not all of the companies, but I think even some of the older ones like KKR, who's been around since a really long time, you'll see them change. I've seen specific cases where they buy a business, instead of just coming in and saying, we know better, they talk to the employees. They get to know how the business runs really well. It's not just, as we used to say, it's not just the bean counters, right? The guy's just looking at the numbers saying, oh, get rid of this, get rid of that. But they're just looking at their spreadsheets. They're not talking to the people.
Yeah.
Now they're talking to them. Now they're putting in bonus pools. Now they're putting in incentives so that the people that are running the businesses or further down the line that are the employees in the factory, the warehouse, whatever it happens to be, they get economic incentives. And you see that the outcomes have been at a different level of return for them, because they're more constituents get to win. And so when you have more, if I win, but the other guy has to lose, it's not as, in the long run, if you can have the buyer wins, the seller wins, the employees win, the customers win. So if you can get the quadruple win, it's the best outcome. Everybody's happy. It can happen. And even though you'll say, okay, most of these guys are very ruthless and aggressive. Yes, many of them are. And that's how they've built their businesses. So I'm not critical of that. But what I'm saying is that it seems that as the world has evolved, sometimes you have to be very aggressive and very ruthless to get the deal done, or you're not getting it done. I mean, right now, so for QXO, which is Brad Jacobs' current startup, I'll say, he's raised more than $5 billion. He put $1 billion of his own capital to start it. And they want to roll up the building products industry. Well, the company they want to buy doesn't want to be sold. And so they're doing a more aggressive approach. But it's interesting. So they're pushing to acquire it. The company's management and board are fighting. But at the same time, he has published a letter to the employees saying, this isn't you. This is your management. This is your board. We love you guys. We want you to be part of the future. And so it's this combination of compassion and accountability and being aggressive, all in the same bucket. And so I think some of the private equity guys are, going back to your question, evolving. Some are not. Their view is, no, I buy it at 2, I sell it at 4, I used leverage, I got in, I got out, my investors are happy. Others are thinking we can probably get maybe another turn or more on the multiple, but they're still thinking about, see, what I like about some of the serial acquirers, they're not thinking about selling, they're thinking about buying. All their effort is in buying. It's easy to sell a good business. You just don't want to do it. And so it's hard to sell a bad business. Well, you want to do it, but the other person doesn't want to buy it. And so you see, because these groups are focused on buying, not selling, their whole mindset is different than the traditional private equity guy, who before they buy, they are thinking, what can I get for it if I fix it, if I turn it around? And they're buying companies that are not always great, or they've stumbled. I've invested in companies over the years where I said, okay, it's a good business, they've stumbled, it's fixable. And so I also look at, so I want to buy great businesses that keep compounding, but I'll also look at companies where I say, okay, they stumbled, but I think it's fixable. And so then you need to know who's going to do the fix. What's their track record of fixing? Or are they good at breaking, not fixing? Well, they shouldn't be in this one. Again, send them to the competition. Always have the weak managers go to your competition. It's the best way they can help you.
And I mean, one thing that Jacobs has really succeeded with is sort of scaling the business, doing a lot of acquisitions. And so what do you think are sort of the main barriers to scaling? Because it's not so many businesses within, serial acquisitions that has really succeeded in scaling at the level that Jacobs has.
They spent, I forget what he said, but it was a few years he spent before creating QXO to do this for building products, looking at all kinds of industries, saying, where do we see highly fragmented? Maybe there's one or two larger players, but they're not enough. They're not at a scale that dominates the whole industry. They're big, and there's so many small players that they can get in. And then the key is, if it's because he's attacking very large markets. He's not going for small niche markets. He's thinking big. He's thinking beyond big, mega. I don't know, what's bigger than bigger, mega. I don't know, whatever, supersize. Yeah. And so he's aiming so high, and so maybe there are less industries that are that fragmented, but then what do you really need to make it happen? Money. You need the capital. You need to be able to raise capital. And I'm sure when you go back to the history of the companies he's built and you look at how they raise the capital and how they put the businesses together, I'm sure the first ones were not that easy for him to raise the capital and get them off the ground and going. And there were probably a lot of groups. When I worked back for Michael Price in the old days, we always thought, oh, these guys that are roll-ups, let's stay away from them because they always make mistakes and there's always problems. And you really don't know what you're getting because you're betting on what they buy tomorrow, not it's what they have already, but it's really, you're betting all on the future and a continued growth and a continued following their own discipline and process. And so we kind of stayed away from them. But when you have somebody like Brad Jacobs, who has eventually proved it out by doing it successively over time. Now, all of his companies didn't just go straight up, but with time, they have been incredible performers. And so when they were putting this QXO together, I thought, okay, for me, this is different because his record is incredible. He's just as motivated and driven as he was for the others, maybe more so. And because he became so wealthy from all this creation of value, and he didn't just create it for himself. All the shareholders did well in the other companies. The employees did well. As I said before, the customers are a winner. They get better service, probably better pricing on the product. The employees are participating, right? So there's multiple wins. Now, maybe he wins the most because he was the main owner. Okay, but everybody's a winner. What's wrong with that? Why shouldn't you get rewarded? He took the most risk. With QXO, he's taking truly the most risk. He has put the most of his personal fortune, which has grown. For him and his family to put around $1 billion, it's a lot of money. And so but they haven't made a single acquisition yet. So right now, and it's a listed company now in the U.S. So you're paying more than the value of the cash currently, but you're paying a premium for him, and you're kind of paying more than cash because of the track record of the prior successes. But I've evolved as an investor, and I say I'm willing to bet on the future. I started doing that a long time ago here in Sweden when I was buying companies here, especially companies that are serial acquirers, which were not called that when I first came here.
And at the time, you didn't pay so much for growth as you do today, because I think the model has been proven.
Yeah.
Some of these operators have been doing this for decades with such results, and that's why investors are now paying up for the growth ahead, I think.
Yes, it does get a little scary to see these valuations because the investors have such high expectations now. And so but the companies in general have delivered. Some have not, because some have different models than others. And you realize when they're mindful of the balance sheet, when they're mindful of how they do their process, so even though they look like they're just doing some of this, some of that, something else, and it looks very, I'd say, haphazard, it probably is haphazard in front of the curtain. But behind the curtain, they're calculating the numbers, getting to know the business, getting to know the people there. Are they selling because they want to leave, or are they selling but they want to stay? They just want to monetize it. And they still keep some of the equity. Maybe they only sell 70 or 80% and they keep the rest. So there's different models, and the reality is that it's working in the whole. There's always, I think even the best ones, they'll make acquisitions, and if you ask them, and if they're really very honest with you and say, you made, 200 acquisitions, or if you're one of the small ones, you made 30 acquisitions. Tell me about the ones that you didn't get right. And what did you learn? It's not just to give somebody a hard time. What did you learn? How are you changing, if anything? Were you wrong? Did you get taken advantage of? Meaning, did the seller lie and you just didn't catch it? Or really, did the industry change? Was there a recession and that product would come back? So it was a temporary setback. So in the end, it was a good investment. There's so many outcomes. You're buying these things, and then it's like you're at a crossroads, and there's many paths that you could take. You could keep acquiring. You could just run that business. There's so many things that you can do, and there's so many triggers that it's like when you watch an old movie and they're in the submarine, and you see there's like 1,000 levers, and the guy's hitting all these levers, and somehow he can make it go lower, go higher, shoot the torpedoes. And us mere mortals are looking at it and like, what the hell is that? Because it's before they had, the technology of today, where you could have less controls, but you control more. Yeah. And in a way, that's what some of the serial acquirers in some way are like the old ones. There's so many levers depending on the way they go. There's so many opportunities, but there's also so many opportunities to fail. And that's why it comes back to who are not just the people at the acquired companies, who are the orchestra leaders. They may not be able to play any instruments, but they're setting the tempo. So if it works properly, it sounds really good. If they don't, it doesn't sound good. You don't want to be a shareholder.
And a lot is about those operators.
Yes.
How do you view the key person risk there if something happens?
Well, it is a key person risk. And so then, is there a team? Is it just one person who sets the tempo? But how do they train the people on their team? Are they trained? Or are they is it one person running it like it all rolls up to one person and he or she makes all the decisions and the other people are really just bringing ideas? That probably is a tougher one because it doesn't it may not live beyond that person properly. And then you have a real problem. If they train and have time to really think of their own existence, not existing, you see, and sometimes people just learn by being there, meaning that person might be very aggressive and overbearing, but the people at the senior levels are there for 10, 15, 20 years. And if they haven't learned by then, they're never going to learn, but they do learn. So without that person at the top, it is a handoff. So they're not always specifically trained necessarily, but they kind of absorb it. I think it's better if they're specifically in the field. They get to understand how it works. They helped find some of those acquisitions over the years. They helped, when there were problems, deal with them, because there's always going to be some problems. It doesn't matter if you're Berkshire Hathaway buying a company, or Lifco, or Röko. I know I keep saying those two, but I mean, I could say any of them. I mean, you want to get, as long as you get more right than you get wrong, you're probably going to compound well. And if you learn from your own successes and mistakes in the future, you should have fewer mistakes and hopefully less costly. And I'm not saying those guys had any mistakes. I'm just saying, just generally speaking, you can't get them all right. You just can't.
And coming back to Brad Jacobs, how is he handling this?
What do you mean? In
building a team and making sure that it continues for a longer time.
I think when you go through their companies, you see they have very high quality management teams, and you see people. Again, I think I said it before. He's probably a real tough. I don't mean tough like a tough guy, but he holds the bar so high for people. But I think he holds it highest of all for himself. So his expectations for the people on the team are ridiculously high. And if you can't handle that, probably working at crazy hours, talking about deals and opportunities and strategy, and if there's problems, how are you going to fix it? Don't make excuses. Give me results. I don't know if that's what he says. I assume it's things like that. But when you see the results over time, you see, they deliver. And now if they don't, they're probably not there for the long term. So I'm sure it's a high pressure environment, but those who can, look, it's just like an athlete going to the Olympics. The training's intense. Right? Not everybody's, there's only one gold medal, right? I mean, for each event. And so it's a lot of intensity, but I'm sure these guys feel like they are Olympians when they hit their targets or beat them, because you get, I know, just bring it back to when I worked for Michael Price, when you had something that really worked, you felt great. When you had something that didn't work, you felt terrible. And not only that, he would talk about the things that didn't work in front of everybody. So you really felt terrible and horrible and whatever else you want to say. And when you did a great job, you kind of didn't hear anything. So, because that's what you were here to do, he would say, if you said anything about it. And so that was a different kind of stress, but it was similar is my point. And so the people that I work alongside who were able to navigate it, we felt like we were part of something special. And I would imagine that that's how people that work for Brad Jacobs, I've talked to a few people there that I've gotten to know over time. They love being there. They love being there. They work hard. As we say in America, they work their asses off. And the fact is, but they love it. They're part of something special. They work for a guy that they've learned a lot from, and they get rewarded for the success. But I think I said it before, it's compassion and accountability. I actually think those two words are said in his book a couple of times, and it's true. I think that's how they think about it. And I think the results push that to the front, meaning it's the way it is. And so, Yeah, so people should read the book, even though I just gave them the summary.
So there's a lot to unpack in the book, and we can't go through it all. We, of course, recommend everyone to buy it. Is there anything else that we have not brought up so far that you would like to mention from the book?
The one thing that he says is he talks about the mindset. You have to have your minds. You have to have your brain tuned into what the goals are. But you also have to have I think it talks about reconfiguring your brain. But it's to reconfigure your brain to have the mentality that's focused on thinking about innovation and change, and not to be fearful of it, but how to take advantage of it and how to use that to evolve the business. And so pushing people to think more creatively, I think that should be the case in everything you do. It's not just in the business. Some of the best investors and the best people in all kinds of areas are creative thinkers. I think of it a little differently. I think creativity is important, but I also think of people who are what I call non-linear thinkers. You're not thinking A, B, C, D in sequence, or 1, 2, 3, 4, 5 in terms of what you're working on. You might look at number 1, number 10, number 8, number 50, and yet in people's heads, it's actually giving them a better perspective of what's going on, because that's kind of how the real world works. Things don't work in sequence. And so people who can think sort of in real time when many things are happening tend to be able to deal with more problems, more good things, and get goals achieved, because that's, as I said, that's the way the world really works. It's not organized for us so that it's very straight and linear and sequential. It's just not the way things are. You want to believe that. I know in my own firm, we would say, I want people who are nonlinear thinkers, but they're linear writers, meaning when they write their investment thesis on a case, it should flow very naturally. Take us through the case. What are the risks? What are the opportunities? What's the business? But the numbers should flow and the business case should flow out of that. You shouldn't write it where it's all over the place, because then it doesn't. So as I say, non-linear thinker, but a linear writer and speaker. Speak it, flow it out.
Is this something that you had a natural talent for, or have you evolved it over time?
I think I had it. Yes, I think when I look at things, maybe it was in my head and it somehow it came out. But yes, I when I look at things, I start thinking, what could go right, what could go wrong. But I try to think, well, that's what everybody else is thinking could go right, and what could go wrong. What's the crazy thing that could go right, and what's the crazy thing that could go wrong, and try to think, because you want to really prepare for the worst case and the best case. Some people say, oh, if I focus on the downside, the upside takes care of itself. I don't believe that. If you focus on the downside, okay, you focused on maybe capping your risk, but why does it mean that thing will go up? What's making it go up? You have to know both things. But yes, I think having an eclectic mentality, and when I was working for Michael Price, just to jump to that, I would watch how people would pitch ideas to him, because we were sitting in a big room. You did not have an office. The whole big room was the office. He had an office. He didn't really use it much. And so when people were when the analysts were pitching an idea to him, you could tune in and listen just by watching and learning. And I was a watcher. I liked to watch what was going on to see what worked and what didn't work. And after a while, I realized that Michael was a real non-linear processor of information. And so he would challenge these analysts with questions that were not the most logical next question. And some of them could handle it, and some of them couldn't answer those. I have to come back to you. I have to come back to you. And I would see the same person would always have to come back with answers, where yet another person was always ready for those answers and had it ready. And I realized this is going to be good for me in the long run, because that's how my brain works. So I've started watching people who could get ideas into the portfolio more often than people who would get less. So one guy had a 100% success ratio of getting an idea into the portfolio when it was through the funnel of having to pitch to him. And yet somebody else maybe got half of their ideas in it. And there was a lot of, let's say, conversation. I wouldn't say at the most normal level of tone. And this is when I wasn't even on the investment side. I was on the trading desk as an assistant.
Is this late 80s or?
This is
early 90s?
Early 90s. So at that point, I was an assistant on the trading desk. And I mean, even that job, I mean, I probably told you guys this, and then not on this podcast, but at some point when we met, I think in New York, as I said, I answered the phones there, but I still had to go back to school and finish school. This was one of these internships, the 6-month internships. But as I said, I started during the crash, so it was fantastic. And I go back to school. All I wanted to do was get back to this guy. And they offered me a job. Come back and work for us when you graduate. By then, they moved the business from New York City, near the stock exchange, to New Jersey. I don't think I had even been to New Jersey. I grew up in it's the next state. I just had never been there. So I did grow up very sort of not quite living under a rock, but I never went anywhere. I went from New York to Boston for school. I'd gone to New York City. I didn't even live in the city. I lived in the suburbs. And maybe I went to Washington, D.C. once. And when I was a young kid, my father took us to Niagara Falls, which borders Canada. And we didn't even go to the Canadian side. I had never been to any other countries. I wanted to work so badly and just finish school that I actually didn't stay at school for the last semester. I just said, I'll go to New Jersey once I was offered the job, start working, and then I took classes in New Jersey, quickly convinced the school that they should accept these transferred classes so I could graduate in Boston, where I was going to school. I went home one weekend, picked up my parents, drove up to the school in Boston, went to my graduation, drove home the next morning, dropped my parents off at their home, went back to New Jersey, and I was back at my desk on the Monday. But by then, Michael had offered me a job on the trading desk as one of his assistants. But he told me that the reason he was asking me to be on the trading desk was because he had already interviewed 30 people from other firms, and he said everybody has baggage. They think they know what to do. And he said, I'm looking for somebody who knows absolutely nothing. And he said, David, I think you're perfect. And so I didn't know if I should say, yeah. I was just told I'm like the dumbest guy in the room, and he wants me to be the assistant. But I was happy because I didn't want to be at that point I was in the accounting department. Yeah, I didn't want to be there. And I went to be where the action was. And so I think if he ever called me by my first name, that was the only time. Michael always called me by my last name. So he'd call me Marcus, which I know is a first name here in Sweden more than anything else, which seems to confuse people when I'm walking around.
Marcus Wallenberg.
And others, yes. So in any case, so I got the job on the trading desk. That's where I would watch all these guys pitching ideas. And I was on the desk, but after a few months, I said, hey, we need an assistant over here. Meanwhile, I was the assistant. And I said it so many times that at some point, they said, yeah, go get somebody else from the phones, because I started on the phones. So that helped me push myself up. But I was an extremely introverted person. So I was very quiet. I didn't speak loud. Let's say I almost was afraid of my own shadow. Almost. That's just the way it was. And Michael really didn't put up with that kind of thing. And so he would raise his voice and he would scream at me in front of everybody. But it would be things like, I hope your New Year's resolution is to get a louder voice because I can't hear you. And he would slip in a couple of aggressive words in there that I'm not going to say right now. And I realized he was complaining about my volume, not about the quality of my work. And so at some point I became the loudest guy in the room. So I used to tell people he beat the introvert out of me. He verbally, not physically. But it helped me I think, become more of who I probably really was, but I didn't know.
Did you consider quitting? Or?
No, because the person who had been on the trading desk previously had left. I think she just couldn't handle the stress. It was a very tough environment. There was a lot of business. The firm was growing. The flow of investor capital coming in a firm that had $0 spent for marketing. The performance of the fund was so good that investors just discovered the firm. And I think once per year, Forbes magazine, business magazine, would publish the top 20 funds in the U.S. And Michael would have 2 or 3 of the top 20 funds. And right next to the performance of the fund, they would put the phone number. The phones just rang. And so it was very busy, lots of trades, and you had to learn. And kind of previous, this person just quit, and that created this spot on the desk. And my view was, well, when he was really agitated with trades or whatever, it was a very tough environment. But my view was, well, after I got screamed at, and my name became Mr. Resilient. That was my nickname because he would scream something at me and my phone would ring and I would answer it like nothing happened. But meanwhile, inside my brain, I was like very upset. But I didn't let anybody know that because it was a tough firm. Everybody was tough. And so my view was, well, he didn't kill me and he didn't fire me. I'm good. And I just kept coming back day after day after day. But I realized at the end of the day, it was a meritocracy. He really rewarded people that made a difference. And he had one theme. He said it 1,000,000 times. You're here to make money for our clients. That's what you're here to do. And I always thought about that. And so I just stayed, I listened, and I really, if he complained about something, I would try to resolve it. And so I think it was in 1991, there was the Gulf War. And we didn't have any television. I know here in Sweden, you had even less TV in those days. I think you had like 2 TV channels, right? SVT1, SVT2, something like that. And so, because I know when I first started coming here, I was like, what? What's going on here?
Well, we will come on to the man driving the change of that soon, I think.
Yes. But I would think it wasn't what's going on here. It's what's not going on here. Because, and so in any case, Michael would say, well, the cable system, the cable TV stopped across the street where the shopping mall was. We were in an office building in the suburbs in New Jersey. He's like, well, it would be nice if I could watch the war, so it would help us with the trades and us thinking about what's going on in the world. Well, again, you didn't have the technology of today where you could see all this. And I said, well, what if we have a satellite dish? He's like, okay, why are you still standing here? Where's the satellite dish? And so I didn't know anything about satellite dishes, but in those days, they were 10 feet wide. And I found some guys to install it. It was guys selling satellite dishes from their cars. I mean, this was people in very rural areas that had no other access. And he just kept, I would say, screaming to me, Marcus, when is this thing going to work? Is this war going to end before this thing works? And so finally it took me, because the people stopped showing up, and all of a sudden I'm pulling cables through the building. I don't even know what I'm doing. I realized I had an idea to be helpful, and it kind of backfired. But the short of the story is that I got it set up, and I still remember it like it was yesterday. He said, Marcus, you did it. You got this thing working. Too bad the war ended 2 weeks ago. And so, well, at least we had it in case there was another war. So, but it didn't stop me. I wanted FaceTime. I wanted to be front and center. I wanted him to notice me. But eventually, to just bring it to the investment side, I realized that all the real decisions were made by him and the other investment analysts. The traders were buying and selling, but you had only a limited amount of flexibility. Those guys were making the decisions. I wanted to do that, pick the stocks. And so I told him I would like to be a stock picker. And he said, well, start showing me ideas on your own. And so he said, I don't need any more analysts. So whatever, show me ideas. Let's see what happens. So for the next year, I started working on ideas. I really didn't know EBIT. I didn't know, but I knew I always read about companies. I always was focused on it, but I really didn't understand how to value a business and how to look at a business. But one of the other guys there, a guy named Rob Friedman, who eventually became the chief investment officer, he and I were friends, and he was a senior analyst at that point. And so I really learned from him and from Michael. But from Rob, I learned all about how to value a business, how to look at a business, how to find ideas. And I would challenge myself. What stocks did the fund own that Michael bought? And I would try to figure out why he bought it. I wouldn't ask him. First of all, I was afraid to ask him. But I wanted to figure it out for myself. If somebody told me why we owned it, I wouldn't learn as much as if I first tried to figure it out for myself. So I had to kind of self-teach myself how to look at ideas. So I did that for quite some time. And then at the end of that year, he said, okay, you could be as we would say, the grunt. That's the most junior person you could be. And I became the junior grunt for him and the other senior guys. And so I did that. And then I'll say this. So I did that for some time, and we would get a lot of Wall Street research, but it was physical paper. Again, no internet, no email. And I would just read everything I could and try to understand how people looked at businesses, how they valued them, what made a good business. I would stay in the office late, and any of the analysts that were there were talking about ideas, and I would listen all the time. I was a watcher and a listener, and I wanted to be a sponge and learn, always listening. And at some point, so now we're in the early 90s. I got off the trading desk. Maybe I'm 26 or 27 years old. I've been there a few years, and I read a research report that talks about some companies here in Sweden. And so I had heard of Sweden, but I still had never been anywhere. So, but I realized there were these holding companies. So, of course, there was Investor. There was, in those days, you had Investor, you had Ratos, you had Custos. It was a whole bunch of them. But there was also a company called Incentive, which was ultimately was controlled by Investor. But before that, it was controlled, I think, by Volvo, who sold it to Investor. And within Volvo, there was Pharmacia. They were all these conglomerates within conglomerates and businesses within businesses. And then the more work I did, I realized Sweden was going through a financial crisis. The banks were bust. And the government was bailing out the banks, creating, they had seized assets from people like real estate. So they were creating these real estate companies. And so I said to Michael Price, I said, these companies in Sweden look really cheap. And we had one guy in the office that did all the non-U.S. investing, a French guy who would always say there's only 4 countries that we should invest in. Of course, France, Germany, UK, Switzerland. And he would say all the other ones were not worthy of being invested in. Well, okay, whatever. I didn't know anything. He leaves. Nobody's really focused on the international. But the guy that I worked the most with, Rob, he said, let's look at the international. And he started focusing on it. And I said, well, if you're going to do it, I'll do it with you. I'll be your grunt and I'll help you. And so then I discovered these companies here, and basically Michael said, okay, go to Sweden, check it out. And I think I said, what do you mean go to Sweden? He's like, you have a passport? I'm like, no, I don't. I didn't need a passport. When you go no place, you don't need a passport. And so I got a passport. I came here to Sweden. And first of all, so this is I discovered Sweden for the Americans. Okay. And so I came here and I was like, this is fantastic, because I felt like I had the whole, as a foreign investor here, I felt like I had the whole country to myself, because I realized in a crisis, people go home. So the Brits went back to UK, the Germans to Germany, the Americans to America, whatever. So I came here. All these companies are in dire need of capital. The bailout's underway. The bank stocks are trading at nothing. And I didn't know how it really worked here. The one thing I could recognize was McDonald's. I'm like, okay, whenever I felt like I needed the comfort of home, I'd just go in there. Didn't taste exactly the same, but I liked it. And so, in any case, I quickly realized that there were all these individuals and families behind the companies. And I just started calling on the families. Because I thought, if you own 40% or 50% of a company, I have to know what you think. Because you could fire the CEO that day if they weren't one of your family members. And so I would call on these investors, the owners, and I thought that's what everybody did. And I realized it's not how the world worked. Most people started, if they even had an investor relations person, they would start with that and talk to them a lot of times, then would talk to the CFO and kind of work their way up. And you'd never get to the main owner because there were roadblocks. They didn't want you to talk to. They didn't want to talk to you. But if you called them first, they were so not ready for the call. Like sometimes they took the call by accident. And then it was easier coming down from the top. There's no roadblocks. And so I shifted my energy to that. I started coming back here like every 6 or 8 weeks. I was like, this place is great. I need to just keep coming back and just consume knowledge and understand who the players are. And so I did. I got to know the companies, the families, the individuals. And at the time, I think the marginal tax rate here was like in the 90%. And so I thought, if they ever cut taxes here, a lot of these families are going to become billionaires, maybe even in dollars, not just kroners. And so, which eventually happened, right? And so, but I started calling on all these families, and I would come back to New Jersey and talk about what I learned here. And so then in the early 90s, Michael launched a global fund that this guy, Rob, really led on that fund, and I worked with him. But eventually we were finding so much to do, and we came here, but then we started going all over the Nordics and then all over Europe. I kind of went anywhere except UK, because all the other Americans were going to UK. So the stocks were not cheap, because they somewhat similar language, right? And the accounting similar. And I'm like, they're all lazy. They're going to the UK. I'll go everywhere else. It's cheaper because you have to do more work. And so we did it. And then we started putting a lot of capital to work here. All the holding companies were trading at a discount, and even just regular operating businesses. I remember Skanska, the construction company, they had an enormous stock portfolio. So they had this equity portfolio, and inside the cover of the annual report, it said hidden assets. They actually said the word hidden assets. And it was the equity portfolio, which they only priced like once a year. And when I priced it manually on a piece of paper, I said, it's worth more than the market cap. Because even though the stocks were down, the value was just there because the market didn't focus on it. They only focused on the business side. So, okay, these are just like the cheapest companies. You're getting the business for free. So we started buying things. And then in the mid-90s, he launched a Europe-only fund, and we were buying a lot of Swedish stocks. So we bought 8% of Investor. We bought like 15% of Ratos. We bought a big chunk in Incentive. And then at some point, I got to know, I always ask the same question. Who are the value creators? Who are the value destroyers? And I would try to seek both out. And eventually I did that in every country. Who are the value creators in this country? Who are the value destroyers? So I started in Sweden, then I went to Denmark, Norway, Finland, Portugal, Spain, Italy, Germany, and just worked my way around France. And same concept. And I would spend a lot of time traveling. So I was getting millions of miles on all the airlines. And I was just always on the road. And somehow I have 4 kids now. And but I was never home. And so I was always on the road because I was on this quest for knowledge. I wanted to learn, but then I can convert it into an idea and we would make investments. The great thing about working for Michael Price, there were many great things and many great lessons, but one of the great things was he just wanted you to help find ideas that were there to make money for the clients, the investors in the fund. And so if you had a good idea, he might give you a hard time to make sure you really knew your stocks. But once you could get through that obstacle course that he would throw at you verbally, he would put a lot of money into it. And so it was just incredible training. It was like the Olympic training again. And so we did it. We put a lot of money to work here. I think in 1 year we put $1 billion into this country, like in 1996. That was the year he sold the company. So he sold it to Franklin Templeton. It became Franklin Mutual. And then he left the firm in 98. I left in 2000. But I mentioned it before, I started to meet all these families behind the companies very early on, and I kept coming back over and over and over. And one of the hardest meetings to get was, of course, Jan Stenbeck. He didn't meet with investors. And but everybody, when you asked who are the value creators here, they would say, you have to speak with Jan Stenbeck, but he won't speak with you, you know. So I was like, I'm getting a meeting with this guy. I want to learn. And
it's a funny story, I think, on how you were able to meet Jan Stenbeck that we have heard.
Well, so he would spend time, of course, here, New York, I think Bahamas, and Luxembourg, and maybe in those days other places, I don't know. But I tried for a long time to get a meeting. Finally, a Swedish broker who was working in the Citicorp building where Jan had he wasn't on the top floor in those days. He eventually had the top floor. I think he was on the 55th floor out of 59 floors. And this guy, I think he camped out at the elevator knowing that Jan would, if he was in New York, he would be in the elevator at some point. And he cornered him and he said, I work at whatever. You have to meet David Marcus because he's putting a lot of investment into Sweden. He would like to meet you, but he won't buy the stock unless he meets you first. And then finally what I realized was, I'm not getting a meeting with this guy. I said, what if Michael Price comes to the meeting? So Michael was not doing a lot of meetings at that point. He had people like me doing it. And so somehow that did help. So Michael and I, and Michael didn't know anything about Jan. Michael was very U.S. focused. I shifted to Europe because it was cheaper, but also whenever you pitched an idea to Michael in the U.S., he had an opinion already because he had done it for so long. And for Europe, it was like a clean page. He'd listen to you. I'm like, oh, he'll listen to me and it's cheaper. And there's catalysts. There's all kinds of change going on. Because before I answer your point on the Jan Stenbeck meeting, I'll just point out one thing I forgot to say. In the early 90s, the other thing that changed here that made it so incredibly good as an investor was that the currency floated because it was fixed rates before that. The foreign ownership rules changed. So there were real restrictions. It wasn't just A shares and B shares. It was for certain sectors or industries. You couldn't own more than a certain percent. Those things changed. So a lot of things converged to make it a better investing market. When I got here, there was no corporate governance. You would see companies where the CEOs would sell their personal shares, and the next day they would have a profit warning. I remember saying it to one CEO. I'm not going to say his name. Like, what? How could you do that? He's like, well, I knew it would be a bad day. Why would I keep the shares? I'm like, well, that's today. That guy would be in a lot of trouble.
Yeah.
Right. But back then there were no rules. That was a little disconcerting. So in any case, we meet with Jan, and in the meeting, it's kind of weird. In the meeting, he's just eating a candy, like gummies, like gummy fish, we call it Swedish fish in America, right? Gummy worms, gummy this, gummy that. I'm like, this guy's eating all these gummies in the meeting, but he was eating like a lot of them. And it was just like the craziest thing because I'm like, Michael and I are asking questions about the businesses, and they were, all the businesses. They hadn't spun off Tele2 yet. They hadn't spun off. You had, and I'll mispronounce it, but I'll just say it in English, which is Kinnevik, just because I'm going to get it wrong anyway. But we had Kinnevik and you had Millicom, which didn't trade here, only traded in the U.S. And so I don't think any of the other companies were on the market yet. They came soon after.
Which year is this?
This is maybe around 1995, either 95 or 96, in that time frame. And so we have the meeting, and I'm like, I got to figure out where he got that candy. So then the next day, and Michael, afterwards, we talked about the meeting. He's like, oh, that's an interesting character, that guy. And I'm like, we have to own this thing. let me get started with it. So we started nibbling on it. I used to say, let's nibble. Let's take a small bite, not a gobble. A gobble's a big bite, because we would start with a small bite. Then if it went down, another small bite, and another one, and another one. So we were generally nibblers, not gobblers. But if we really loved something, at some point we would start gobbling. So in any case, I come back into New York City. Remember, we're in New Jersey, so I drive into New York the next day. And I'm like, I'm going to find out where he got that candy. I want to buy some and send it to him for the thank you for the meeting. And I go to the Citicorp building, and I spend 3 or 4 hours walking all around Manhattan trying to figure out where the hell did he get the candy. And then I had this great idea. I'm like, maybe it was in the building. Because I looked at everything around the building. I go in the lobby, there's the candy store. I spent half a day looking for it. I asked the guy, what's the biggest box you have? And I think it was like a 3-pound box, right? Maybe even 4 pounds. It was a huge box. The guy's like, nobody's ever used this box. Because it's candy, you buy. I'm like, give me it. I put all the gummies, the worms, the this, the that, whatever I could figure out. I take the box, even though he's in the building, Jan, I take the box back to New Jersey. I write a nice note. I package it. I ship it to him. The candy got me my second meeting. I didn't have to ask Michael to come to the meeting. And Jan invited me to come back in for a coffee. And then and I told him we started buying the shares, and then we kept buying it. And then over time, if he was in New York, I would say, if you're in New York, do you have time? And then I started meeting him here. And slowly we got to know each other. So I went from he wouldn't meet investors to he and I would just have lunch, coffee, whatever. And I really didn't understand that. He just didn't do that with people. And so, like I said, for some reason we clicked, and I got along really well with him. And
was it because you were similar in some ways, or did you have anything in common, or?
He knew that I had invested in some of the other companies in Sweden, and he would say, well, why would you invest in that company? They inherited their money. I'm like, but didn't you? And so I would challenge him, but I'd say it with a smile, and oh, well, maybe a little bit, and so, but it was, but it's what you did with it during your time that counts, right? Yes, you got the start because your father built it, but what he did, each generation, and we can talk about it, I guess, later, has done something different with it and evolved it. But in any case, yeah, I don't know. I mean, I just loved what he was doing, and then they started spinning off the companies, right? There was one thing called SEC, which was a telecom, I think, in Luxembourg. Then there was Tele2. I think it was called something else, Netcom, before it was Tele2. And MTG, and they just kept peeling off other things, and just the value was there, because the conglomerate, unlike today where the serial acquirers are different than conglomerates. I mean, Jan didn't acquire companies, he built them from scratch. It was a different model. It wasn't even a model. He didn't think of it as a model. He just was an innovator. But I really loved talking to him, sitting with him, hearing how they were building the businesses. It was really amazing, because you didn't have a lot of the other companies here. They were already existing players in these businesses. They weren't innovating, creating, copying, taking advantage of, or trying to break the government's monopoly or any of those things. And so it was just, every time you'd see just more interesting things coming out of it. And the people either loved him here or hated him. It was very polarized. There was nothing in the middle. It was, we like him, we don't like him. He was very aggressive. And so in any case, I got to know him. We eventually bought 8%. And then when they spun off the other companies, we had 8% of all the companies. And so I got to know him really well. And as I said, I'd meet him either here in Stockholm or in New York. And when they were thinking about doing things, he would say, well, we're thinking about doing this. What are your thoughts? And it was great to have him asking me. But sometimes he would say, I think you know more of the Swedish business gossip than I know. Like, well, maybe if you were in Sweden more. And I said it as a joke, because he was traveling so much. But I was coming here so much. I said it before, my wife thought I had a second family here. And so at some point I said to her, you don't get it. I don't have a second family in Sweden. They're in Norway. And I don't have a second family. I'm married 33 years. But I got in a lot of trouble for saying that. The joke fell flat is what I'm saying. So in any case, just to fast forward it, so Michael Price left the firm in 1988. When he left, people got anointed into certain roles. I became head of the European investments. That was about $7 billion. I got my own fund, which was the Europe fund. That was $1 billion. And then I was co-managing the flagship fund, which was $8 or $9 billion US, and the global fund, which was like 4 or 5. So I was managing or co-managing more than half the firm's assets at that point. So I was the kid who started on the phones. Now I'm managing more money than all the other PMs combined. The PMs are, of course, the portfolio managers. And 10 years earlier, I was getting those guys, I was doing their spreadsheets, I was getting them coffee, they were treating me horribly. Now they were co-managers with me because he rewarded you for making the client's money. And I thought I'd stay there for my whole career. And I thought if he ever left, if I could have a shot at running the firm, that would be the dream coming true. I didn't think about leaving. But ultimately in 2000, I decided it was time to move on. And so I called all these families that I had stakes in their companies. I said, look, I'm going to leave. Somebody else will be responsible for a huge percent of your company. And I'm going to do my own thing. And when I called Jan to tell him, he said, well, I'd like to be partners with you. Spend the weekend with me in the Bahamas on my boat. And I did. By the end of the weekend, we had a deal. And he said, I'll invest $100 million with you, which in the year 2000 was the equivalent of like a bajillion dollars today. Right? It was an incredible amount of money. I hadn't even quit my job yet, so I had to go back and quit my job.
And the stock market crashed in March 2000, right? So
that's right. So you had the NASDAQ bubble.
Before or after the crash?
We struck the deal in the Bahamas in the December, and then I didn't even quit my job until February. I wanted to wait till my next batch of options, vested at Franklin. And then the week after that, I said, I'm moving on. And so I left, and I was very lucky. One of the business newspapers in the U.S. did an article on me leaving because I managed so much capital. And it was great because then so many investors called us. So the fund grew very quickly. We focused on Europe. And then I proceeded to have, I think, the 2 worst years of my investment career, having had incredible success in the prior decade. And it wasn't just here. I was doing things all over Europe. It wasn't just here, but we had more money in Sweden than we had in any other country. But we really covered the whole spectrum because there were conglomerates and holding companies, especially in France as well, that were going through these restructuring. So I was just trying to take advantage of the cleanups of all these old, in some cases, 100-year-old companies that were finally getting new managements and restructuring and refocusing and merging and selling themselves. So in any case, I kick off the business with Jan, and then unfortunately, 2 years into that, he died in 2002. He was 59. That's how old I am today. And I still think about how much he achieved by the time he was 59. And I feel, man, I have failed because he did so much so fast, so young.
What do you think, philosophical question maybe, but what do you think would have happened to Kinnevik and his companies if he would still be alive today? I mean, how much value do you think he would have created versus what's actually happened with these companies?
Oh, that's a tough one. Look, it's hard to say what something would happen over 20 years where somebody's not here, but I think the group would look very different today. But I think also he would have been more known around the world because the businesses that he had were so scalable. These were businesses that could easily be in any markets, telecom, media, the newspaper business. Okay, that became a digital business, but I mean, over the years, the group exited all of them. to focus in a different area. And so it's a different outcome. It's hard to say what would have happened if he had existed here longer, be it 5 years, 10 years, 20 years, whatever. I think he'd be 80 now.
Yeah.
And so, but I think it would be different, and maybe they would still have those businesses. It's hard to say because I never thought of him as a business seller, but more of a business builder. So not a buyer either. Maybe he would have evolved to buying, but I think more entrepreneurs would have gone to him with an idea, and maybe it would have been a different level because they may have backed other Swedish entrepreneurs. I don't know. It's so hard. It's hard to speculate because it could go in a variety of directions, but it would be different.
Yeah.
And so, but look, like I said, he unfortunately he died at a very young age, and very briefly, Christina, his daughter, was working with me in New York at that time.
Mm.
And then that was another chapter where she asked me to help her. And so I helped her build a family office for her family, herself and her siblings. And we built that. And then I went on the board of MTG. I became the chairman of their U.S. holding company. These were things I didn't expect to be doing.
Yeah.
So I went from being an investor to being an operator, sitting on the boards, helping make decisions. Companies like Millicom were having a real problem. They were almost in bankruptcy. So in the 2 years before Jan died, the share price of Millicom went from $80 per share, where it traded in the U.S., to 50 cents a share. The market cap went from $3 billion to $30 million. And it had $1 billion of debt. And the bonds went from what you call PIK, payment in kind, so they were paying with more bonds, to cash pay. And the company had no cash. So that caused the stock to go down. And I got hired by Millicom. We brought in a banking firm. We restructured the balance sheet. And then it went from 50 cents to more than $100 a share in the next few years. It became an enormous company. It was a classic fix of a balance sheet. It wasn't the business that had a problem. It was the balance sheet. Always reminding us you don't want too much debt.
Yeah.
And so, I closed my fund. So to help the Stenbeck family, rather than trying to keep the fund going and do that, I just went all in helping her with the family office, sitting on some of the boards, and being an advisor as she was evolving to, I think 3 years later, she became the chairman of the group, I think when she was 27 or so. In the interim, there was somebody else that was the chairman. I think that was Per Gyllenhammar. And so that was an evolution as well, and the group changed. So where Jan changed it from his father, Christina changed it from her father. You can't be the person that preceded you. You have to do your own thing. And so, in any case, so that evolution occurred, and the company's in an interesting situation today. They have probably a lot of things I've read the press here. I see what people are writing, and after I put it through a translator. It's hard to learn Swedish when everybody that you come here and speak to speaks better English than I do. And so, but I had this crazy idea early on. I'm going to learn Swedish and I won't tell anybody, so I can see what they're saying about me in the meetings. But it's just I was able to order something at McDonald's in Swedish once.
Or you're
they didn't get what I wanted. Hey, what's that?
Or you're not telling us.
That's true. I'll leave it to your imagination.
You haven't said so much about sort of Stenbeck and how tough he was as a businessman and so on. Maybe
Sure.
we can go in a bit to that. I mean, one thing is that sort of the two mentors that you're speaking about both of them has been super tough.
Yes.
So I think it's interesting to hear sort of, I mean, either I think you love that or you hate that. I mean, for people to be that tough that Michael was to you, for example, some would have just left, but you stayed on.
True.
hated it probably, I mean, sometimes, but still you got stronger out of it. So
that's true. With Michael, yes, I said it. It was a very tough environment, but you felt like you were part of something special. So you worked hard to evolve and learn and contribute. And I did, and others did. I wasn't the only one who did, but not everybody could do it. And the fact is, it was a unique environment, and you wanted to be part of it because his legend was growing, and by default, it pulled all of us with him. But I don't think Michael actually ever came to Sweden. And I remember him saying to me, remember, he only called me by my last name. He was like, Marcus, because the press was writing up us a lot, and many times they were talking about him. Michael Price is doing this, Michael Price is doing that. He's like, how do you feel knowing that you're doing all the work and I get all the credit? And it was like, I don't really care. But it was funny because, and then eventually I was in the press too, but it didn't matter to me. We were here to just make money for our clients. But I loved it. I loved it. I eventually, his relationship and mine evolved because after I left, I stayed in touch with him. And what I just realized was that over the time was that Michael was just, first of all, for me, he was an incredible mentor. He really, he trained me, but he also gave me an incredible opportunity. Because yes, when he hired me, I would tell you, I told you, I started at the bottom answering phones. And even when I was on the train desk, I made a lot of mistakes. I didn't know what I was doing. And he did something for me he didn't do for a lot of people. He gave me quite a few second chances. And with just for whatever reason with other people, he was just like, this isn't going to work. And in my case, he just gave me more chances till eventually the light bulb in my head finally went off a little bit. And I said, oh, I get it now. It took a while, quite some time, but it finally went off. I got it. And that changed. And then, and maybe because the stocks that I bought started to work, and there was a period of time just everything we did worked. And we really caught the wave here so well. We didn't realize it. But once again, I'll say crisis periods create fear, but also opportunity. And if you could be rational, going back to those early days when I started working for him and seeing how relaxed and calm they were during that crash in 1987, it helped me understand that only the people who panic end up regretting it. And so these are like life lessons, but they're business lessons. But I would say Michael changed my life professionally, but also personally, because it did help me, I would say, become who I think really was, more willing to speak, more willing to get out there, more willing to. And when Franklin acquired the firm, they wanted us to get up in front of crowds and speak to people in the investment industry. And I would see Michael do a presentation with no preparation, and he would just talk about what he knew. Sometimes he would say to somebody in the audience, hey, I see you have a newspaper. Give me your newspaper. And he would just take the newspaper, and he would say, this is how I work. And he would say, I read this, I read this, I read this. And he would explain how he would assess data and look at things. And one of the most important triggers in the newspaper was a section in the Wall Street Journal that was called Who's News. And Who's News was about management changes. And the lesson was, when it's there, sometimes it's a very old, sleepy company, just got a new CEO. We should look at it. Maybe there's an opportunity. It's maybe a game changer. These were little nuggets of knowledge that was not the way most people thought about it. Usually you didn't even read that section. Who cared? He read it. And so it was real training, but getting me to sort of be more sort of, let's say, not an introvert inside an introvert inside an introvert, just being a normal person, I guess. But also, like I said, being willing to get up on the stage, talk in front of people. But when he would do it, he would always have lessons that people learned. I meet people today that say, I saw Michael present 35 years ago. I still remember what they say to me. And because they got something out of it that stuck with them. And when I first had to get up on a stage in front of people, I had, pages and pages of notes. Of course, inevitably what happens, you drop your notes. Now it's out of sequence and you look like an idiot on the stage. So that had happened to me. And I realized I need to do what he does, speak, have it in my head, so I don't have to worry about notes or bullet points or whatever. And ultimately, over some period of time, I got to that point, but I used Michael as my model for that, to get to that point. Because for him, he was so comfortable doing it. And so, like yesterday, I spoke at your event, right? I didn't have any notes or anything. I just talk about what I know. And just my own history or stories or interesting situations that have occurred in the companies, because it's what I know. But I got comfortable doing it because of I give him the credit for the early lessons. So in any case, and then with Jan Stenbeck, Jan was a different level of a manager. I once got a dinner together for the two of them. I don't know if I told you guys this or not, but so before I left working at Franklin, but I already knew Jan well, and we had such big stakes in his companies, I organized a dinner, and Jan actually came to New Jersey, where the office was, and the three of us went out for dinner. And I thought, all I want to do is get these guys talking and then just listen. I just want to listen. And I still remember when at some point Michael said, well, I buy a stock at a price and then I sell it at hopefully a higher price when we do our homework, and he was explaining it. And I remember Jan saying, you sell? I build. And it was just like they didn't understand each other. But yet they were both these very successful guys who, in their own path, created incredible value for themselves, but also for the people who went along with them.
Yeah.
The employees, the customers, the shareholders, however you look at it. But yeah, so from Michael, I learned about how to find ideas, work on ideas, look at the risks and opportunities, read the footnotes that people weren't reading about hidden assets and hidden liabilities, and find mispriced situations. But from Jan, I learned how you build businesses and attack markets that are either new markets, or you're just saying we can do better than those other people and we can go into that market and go aggressively. I mean, Jan was so aggressive on the business side. And so they, like I said, one was building an empire and one was buying and selling stocks, both very successful. But with Jan, it was great because I was lucky that I would just be able to sit with him. Sometimes it was just the two of us. We like to get cheeseburgers in New York at a place called P.J. Clark's. And it's like a 125-year-old cheeseburger place. Sometimes the cheeseburgers tasted like they were from the opening of the place, but they were generally pretty good. And it was right next door to where his office was, like across the street. And so it's still there in New York. People should go there. I don't own the place, but they actually do have good burgers, even if they look old. And so in any case, we would just go out for a burger and just talk. I loved hearing him talk about the businesses, the opportunities, the risks, but he always was so positive about what's out there. And quite frankly, when I listened, going back to the book, Brad Jacobs, I saw a lot of those characteristics of thinking positively, taking advantage of opportunities, finding things that are not sort of working the way they could work and going in and exploiting those markets. So there's similarities there that I see because they're both business builders. But in the case of Jan, yeah, I was so lucky that I had, in a way, two mentors, Michael Price and then Jan Stenbeck, who I can learn from both very different things. And so I am forever grateful to both of them. Really, it was just life-changing, both. And I will say this, I have 4 kids, I tell my kids all the time, where you start is not where you're going to go or where you're going to end, because things happen along the way. I never thought I would go from being a stock picker and an investor to sitting on boards, helping restructure companies, building a family office. And yet I ended up doing those things. Opportunities come by and you can either put yourself in the path or you can run away from it. And I say, put yourself in the path. I didn't know anything about building a family office. I knew some family offices that were investors with me in my fund, but I just called them in. I said, we have the world's greatest office here. Jan's office was the top floor of the Citicorp. I'd invite them in for lunch and pick their brains. And then we put it together. And then eventually I left to do my own thing, built my own fund again. I stayed in touch with Michael Price my whole career. He joined my advisory board when I started a firm called Evermore Global, which I don't think he joined anybody else's advisory board. So I evolved to a different level even with him, where we would get together, we'd go for lunch or dinner, and he just liked to talk about stocks and businesses, Michael, and I would do that with him. Or sometimes we'd go to a baseball game, Yankees in New York Yankees, talk stocks. So it was always talking stocks. And I just loved it. I didn't think I would evolve to that connect with him. Or once in a while we'd go for dinner. Smith and Walensky's, he liked, steakhouse. Not far from the burger place. And we would just talk stocks. And it just, I loved it. I did. And so unfortunately, in 2022, Michael Price died. He was 70. So in fact, it was basically 3 years ago this month, almost exactly 3 years ago. And I had my own firm. We had a mutual fund and we had managed accounts. We had a lot of university endowments. I was still investing here, and all over Europe and in the U.S. as well, but still always mostly non-U.S. That's where I focused. And I was asked by Michael's family to help them build a family office. And so up until December of 24, just a few months ago, I was the CEO of the Price family office. So he died in March of 22. I joined a few months later to help his family build a family office and manage it. And once they got to a certain point, I decided it was time for me to move on. But frankly, it was an incredible honor. I viewed it as an incredible honor to be asked to do it. There's so many people they could have asked. But also at the same time, an enormous responsibility to the family. This is the guy who trained me. And to many years later, many years later, when I was a lot older, to be asked by his family to come in and help them deal with the things they needed to deal with without him there, unfortunately, like I say, it was a huge responsibility and a huge honor, and I did it. And by some weird stroke of coincidence, that family office was right across the street from where I worked with Jan. It was literally across the street from the Citicorp building. And so I started going back to the P.J. Clark's place, which is next door. And it would bring back all these great memories that I had of going with Jan for the burgers. And so, but I would always get a cheeseburger well done, and Jan would always get one very rare. And then I think he did it just to mess with my head. He would say, "Let's get another one and share it." And I couldn't even look at it. I mean, because I like it well done. And I'm like, I think, and I would be like, "I'll just buy lunch. You can't get." It was just.
So the one that was to be shared was always rare then, not well.
It was rare, and I didn't have any of it. I was not going to eat it. I just, we all have our phobias. Mine are, rare foods, or uncooked foods. I don't know.
But you didn't start eating the Swedish fish.
I've had some over the years, but it is funny. To me, it's just a crazy story, because it's just. But I thought about that when I met other families around the world. I would think, how can I get a meeting with these guys, right? And because if you think the same as everybody else, you're not getting a meeting. Nobody else was getting meetings with some of these families, and so I always would think about what kind of trigger there could be to get a meeting, because I just didn't want to check a box. Oh, I met somebody. I wanted to get something out of it. I wanted to learn about their business, how they built it. But I was very lucky that I was able to do this in a period of time where I could get those meetings. And I realized, yes, I probably was a little pushy with some. Remember, I was not a pushy guy. I was the opposite. But I realized the more I pushed, the more opportunity presented itself. And I would push to get the meeting. And in other countries as well, there were families that never met with investors. Spain, Portugal, I got those meetings. Some of them became investors with me in my fund. And at the beginning, I couldn't even get a meeting with them. And so, because I always wanted to give something back, what could I do to tell them more about how business is done in the U.S.? It was always a sharing. The first meeting maybe wasn't, but if I can turn the first meeting into a second meeting, it became just a conversation. And I wasn't looking for anything except to understand. The more you can meet them, it's like constructing a 3D perspective of the person and their business, how they think. Do I buy into it? Would I want to invest in that kind of a business? It didn't matter to me if they were, some groups cared about the shareholders, some didn't. But some didn't care, but they said, well, you could tag along with us. But we don't care what you think, And I was like, okay, that's okay. It's because we like what they're doing. But if they were using the shareholders as a bank, and somehow the shareholders always got shortchanged, then I had no interest. It didn't matter about the quality of the business. We're betting on the people. And so I would always say, we're betting on jockeys, not just horses. Because the horse doesn't know how to win the race. It needs the jockey to guide it, kick it, do whatever it has to do to get the horse to function. To me, the horse is the assets of the company. And the jockey, of course, is the management team or the family that controls it. And so you want the combination of good jockey, good horse, good leaders, good business. And, Warren Buffett will always say, I want a business that any idiot can run because one day one will. And I believe so much of what Warren Buffett talks about, except that one. Because I don't want a business that any idiot can run. Because he's right, one day one will. And if it's an idiot running it, it's not going to run it up, it's going to run it down. And so we want good businesses, right? We want good businesses with good leadership. And if you're lucky, you have great businesses with great leadership. You do even better. That's why bringing it all the way back to your conference and the research that you guys do, it's great because in the olden days, there wasn't anybody tracking this stuff. And so now maybe that was better for me and others like me because the valuations were different. You guys helped wake people up. It's kind of good news for them, bad news for us investors. But it's okay. I'll still talk to you. But that's it. So it's because now I was very impressed, I'll say, with the quality of the turnout of the people from all over the world that you had. I really enjoyed talking to the different investors and meeting some of the companies. Some of them I just didn't even know at all. So I learned a lot over the last 2 days. And if I could turn the clock back, I'd go back to the other meetings that I missed over the years because I didn't come over here for that. So, if you'll have me back, I'll come next year.
I mean, it's an honor to have you here in the studio and to have you here in Stockholm. I mean, even though you're a frequent visitor in Sweden and have been for a while. I mean, it's we haven't met you in Sweden before, so this is actually the first time. So hope for many more times in the future. And I mean, we started with a book and we will end with books. So this is a book podcast, as you know, and we always want to understand sort of your reading habits, what books you can recommend to our readers. So let's start with that. So is there any books that have been sort of formative for your career?
I told you at the beginning of this, I was always fascinated by sort of the history of not just the markets, but really how it works. And so I would look on the internet for old Wall Street books, profiles of the people who were doing it in the 1920s, the 30s, whatever. A lot of the things those guys did you couldn't do today. They'd be illegal. Their rules were different then. But I wanted to understand how people did things and made their fortunes and invested and traded. And so even the name of my firm that I had built, Evermore, was named after a famous Wall Street guy named Jesse Livermore. His estate was called Evermore. He was a famous short seller more than he was. So he was shorting stocks, betting that they would go down. And he made a huge fortune during the crash of 1929. Yes, that was before I was born.
It's the reminiscence of a stock operator, right?
You're correct.
Yeah.
Well, that's about him.
Yeah.
Boy Plunger.
Right. That's right.
Yeah.
Right. So you're right. And so I just thought it was cool because I read that when he lived in New York City, in those days, the center of the world was the New York Stock Exchange. But some of these guys lived uptown, so it was way up in New York. And he lived in a hotel, and I read that he bribed the police. Why? Now, there's many things you can bribe the police for, but in those days you didn't have traffic lights. The police would pull some sign that would say stop or go. And when they saw his car coming down Broadway, which would go from uptown all the way down to the stock exchange, he bribed them so he would never have to stop. And I thought, I think that's the kind of thing Jan Stenbeck would have done, right? He just like, you see me coming? I don't want to stop. I have to get somewhere. And so I was like, that guy was cool, like Jesse Livermore. And so I like the name Evermore, and I thought it would be a great name for the firm. So we used that name. And somewhere at home, I have a picture of the old estate that he lived in. It doesn't exist anymore. But in any case, so I would buy these old books and get them. And these are like antique books. And I wasn't looking for them as a collector. I was looking at them because I wanted to read them. And so but the one you mentioned, Reminiscences of a Stock Operator, which is about Jesse Livermore, I think it's just a great book. I mean, it was written, I don't know, 90 years ago, 80 years ago, whatever it was. But you just get a feel for how things worked in those days. And I get something out of it. I mean, not everybody wants to read that kind of stuff. It might be very boring for them. But I would buy these old books, and they're very old. So sometimes they would show up at my house, and they're what I would say musty. They smell like old books. And so they would come in the package, and my wife would say, "Oh, is this another one of those books?" Like, how could you tell? She's like, "How could I tell? You know? And I have a nose, and I can tell." And so, she'd leave them outside till I got home. You know. I think some of them are still outside. And so that's where my little library became, I think. Not actually outside, but like in the garage. So I would do that. I'm trying to think of books I do read other books. I'm just trying to think of other things. You know, I do read a lot of, many years ago, there was a book, you might know the title better than me, but I think it was called The Buffett CEOs. It was a book written by, I forget who wrote it, but they interviewed some of the CEOs of Warren Buffett's companies.
Is it Robert Miles?
I think that might be it. Yeah. And I liked it because it was rare that anybody could talk to the people there and publish anything. So even though that book, it might be 20 years old now, I thought it was great. I also think there's a book called More Money Than God. And that's a history of the hedge fund industry. So I'm not a hedge fund guy, but that book, I think it goes from the beginning in the 1940s up until, I think, around 2010 or 11 when it was published. What I liked about it, it gave you an understanding for what hedge funds were started as, which is kind of different from how most of them are today. It was truly hedging to try to eliminate some of your risk. But just the way they describe how they did it, and they profiled people that were the early people doing it. I always thought it was an interesting book, and I've told people that are sort of kicking off their careers as younger people, whether they're in their 20s or whatever, it's a great sort of way to sort of understand it, because I thought it was well written, and it gives you not just the profile of the people, but how it really worked and how it evolved over the years. And so these are not books that I think you hear much about, but I like them a lot. And if you really want to go back, there's a book called The Vulture Investors, and that was written in the 1990s. And that book profiled, the first chapter was about Michael Price. And then it was all the other guys of that era who but they just invested a different way. So even though Michael is considered one of the great value investors, you also realize that in value investing, there's so many definitions of value investing. And so his definition was, as I said earlier, he focused on buying distressed debt and preferred shares and things that most people were not focused on because the pricing was so disconnected from where it should be. And when he started in the business, there were some very large bankruptcies in the U.S. All the railroads were dead, and the government bailed them out. And they made an incredible amount of money because they were able to buy things where they understood it. There's businesses now, all they do is focus on distressed debt. They didn't exist in those days. And so again, I think having it somewhere in your brain, it just gives you a foundation of understanding how things work so that when there's a crisis in the future, it will remind you, well, every prior crisis, when somebody said, this time is different, it's the end of the world, in case you didn't realize it, of all the times that people said it was the end of the world, it never happened, just in case you didn't know that. So it never happened, and in 100% of the cases, that was always a great time to have capital and put it to work. Sometimes people did it too early. Sometimes just they were so scared they didn't want to do it. During what's now called the Great Financial Crisis, people would say in the U.S., "Oh, Wall Street will never make money again. It's dead. It's dead. This time is different." So each time is different because it's a different reason, but the outcome is always the same. But when they said Wall Street won't make money again, what they should have said was Wall Street won't make money that way again, because Wall Street figured out how to make more money a different way, because they always win somehow. That's fine. But the reality is, again, it was a bargain. And what was Warren Buffett doing? Goldman Sachs, he helped effectively bail out some of these companies with billions of dollars. And he got the sweetheart deals to buy certain preferreds. I think it was it Bank of America in the U.S., Goldman Sachs, and there were some others. The same opportunities probably existed elsewhere. I mean, we know that here, I mean, everywhere the markets were down. And so it's just in between crisis periods, you want to put away, like the squirrel that saves the acorns for the winter. You want to put money away for the crisis so that when it happens, instead of being with the crowd that's panicking, you're not trying to take advantage of the crowd, you're trying to take advantage of the panic, where people are just running away, and as they're trying to lighten their backpack and things in their pockets so they could run faster, they're throwing, now I don't know who carries gold bars with them, but they're throwing everything out of their pocket, whether it's gold bars or, chewing gum that they don't want anymore. The point is they just want everything out. They want to get away. And in the crisis and in the rubble, yes, the first thing you find in the rubble is rubble. There's a lot of things that will not bounce back. But when you dig deeper, you realize there's gems in there. And so the key is to not panic. Look, right now, I don't know how much more time we have, but I'll say this, and you could edit this out if you want. You didn't ask me anything about Trump, but I'll just say this. I don't know what's going to happen in the U.S., but there's so much uncertainty out there globally. And look at Europe seems to tighten up and kind of work together during a crisis. And then when the crisis goes away, everybody goes back to their country. And because the U.S. is sort of putting all this pressure on, we're going to pull out of NATO, we're going to this, we're going to that. It doesn't matter. The point is, here's the chance for Europe again to get together in a way, spend some more money, protect themselves, where they're beholden to themselves instead of to America. And I want to believe that America will always be there to help. And I believe that, actually. regardless of all the noise. But the fact is, there's nothing like being your own helper as well. And so the balance of those two things, to me, it's always about balance. And so it's a chance for the Europeans to really connect in a good way. And it only makes it stronger for the future. And I think in a way, Trump might create a bigger problem for the U.S. because if some of the European countries really tighten it up, it's a much more formidable rivalry for business, for growth in the future. And so it's kind of a different kind of a crisis, but crisis creates opportunity.
And there will be crisis in the future. That's something that we can be
know
very
for sure.
sure of. Yeah.
Great. David Marcus, thank you so much for taking the time to come on Investing by the Books podcast to share your insights about how we can become better investors and about the book, How to Make a Few $1 Billion. Do you have any final words you want to share with us?
Just that I appreciate you not only listening, but not falling asleep. And I've enjoyed doing this with you guys. And so thanks a lot. And again, thanks for the conference. I really enjoyed that. It was fantastic.
Great. And lastly, if someone wants to get in touch with you or follow what you're going to do next, how do they do that?
That's a great question. No, I'm on LinkedIn.
Candy you love?
What?
Is there any candy someone can send you or bribe you with?
Burgers?
I'm a chocoholic. I love chocolate. Milk chocolate.
Good.
But yeah, so for next, I'm just thinking about things. I have not taken a break in ever. But I don't think I can take a break for too long. I like to do things, especially if there's a problem and an issue, whether it's a family office or more of advisory with some groups that I'm talking to. But still thinking about it. And in the meantime, coming here to Sweden, it's been too long. And I'll be back again soon. And I hope to see you guys when you're in New York and hopefully in Omaha.
Definitely.
And I will say, if anybody's going to the Berkshire Hathaway meeting, the Warren Buffett meeting, this will be my 26th year going.
Looking forward to see you there. Thank you so much.
Thank you.
Thank you, David.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.